Hi, I'm Greg Robb. I'm economics editor with MarketWatch, and joining me is Claudia Sahm, former Fed staffer and now chief economist at New Century Advisors. We had a really weak jobs report in July, and we had another one in August, but September report that was recently released was much stronger. It beat most market expectations, and the unemployment rate, which had been high, ticked down to 4.1%. So, Claudia, we really glad you can join us and dissect this report and see where you are thinking the economy is headed. So, what's your main takeaway from the report?
This really was all around a great and reassuring employment report. Looking under the hood, looking at all the details, my biggest complaint is that we don't have more of them already. Right. So this is exactly what we need to see. Now, one month of data after we've had, two pretty soft months and well over a year of things slowing down in the labor market. So one outsized jobs print and a drop down in the unemployment rate is not going to undo those concerns. And frankly, the lesson of the last 4.5 years should be, smooth sailing is not something that is in store for us, right? There are going to be bumps along the way, but really, like this is what we needed. We needed to see things stabilizing, have some positive news, and that's what we got with September.
My understanding is the Sahm rule is still flashing red. Is that true?
So the increase in the unemployment rate, the 3-month moving average, is still up a 0.5 percentage point relative to the low over the prior 12 months. It's just up 0.5 percentage point. So it's right on that threshold. And historically, that's been the place at which, you can say these recessions have been underway or not, but it's not been perfect historically. You go way back in the 50s and 60s, there were times where it turned on and turned off. And also, more importantly, there are so many unusual features of this labor market, of this economy, that if the Sahm rule were going to break, as with many other indicators, it was going to be this time. So we haven't seen that pick up in the unemployment rate, and the unemployment rate where we've seen it in the low 4% in recent months. If that's where it stays, that is not a recession. That's a good labor market.
So the signal could turn off in coming months if we have another report similar to the September report. We've
Yes.
never, we have never seen that, right?
There were, again, times, if you look at the historical patterns of the unemployment rate, there were two episodes, one in the 1950s and 1960s, low unemployment rates. The unemployment rate did rise, it fell back, so the sum were it would untrigger, and then within 6 months a recession came. So there are no guarantees with this. It was meant as rule of thumb. It's a pattern. It's not one, and I've talked about, even before this summer, talked about, well, this time really could be different. And there are a lot of reasons. And I think we still need to look at the unemployment rate. And we have seen an increase over the past year. And, some of that are, worrisome signs. And some of it's just an economy that's still adjusting to big swings in the workforce, and a lot of uncertainty probably for businesses on, whether they want to hire and expand.
How worried are you about a recession now? Less so?
We have seen, if you look at all of the information out there about the economy, it's really been pretty good. The labor market's gotten a lot of attention, that it has slowed, had been slowing, was, slipping past what, pre-pandemic norm levels had been. That was a great labor market. So we were moving past that. And so there was some real concern. But even when the Sahm rule triggered in July with the July employment report, I made the point it's very unlikely we're in a recession, because you look and the economy was growing and you have GDP, and we were still adding jobs, even if not at the same pace. And we've just seen, energy prices had come down some. We've seen investment pick up. So when you looked broadly, it things were still looking very good. These rules of thumb, and the Sahm rule looks at the unemployment rate. We've had others that, look at other pieces of the economy. There's been more complexity, more tension across different types of data, that just has not been the approach that works this time. And so even back in July, when the Sahm rule triggered, it was really concerned. We had the unemployment rate moved up to 4.3%. Payroll gains on average were really, slowing off. That was a concern, because it's all about the direction. right? And that also is what the Sahm rule picks up on. It's looking for a change that is large enough that in the past it has been associated with then bigger changes in terms of unemployment rates rising faster, higher and higher. And that's what we were worried about. And I'm less worried about it right now. The unemployment rate came down, job gains look good. 1 month again doesn't turn off all the concerns, but it certainly makes a lot more sense given everything else that we know about the economy. So, no recession right now, and we're not, given what we know, we are not hanging on cliff edge of one.
Are you worried that the Fed might slow down the pace of their rate cuts based on this strength of this report?
The Fed, by starting the easing cycle, starting it with some real intention, with a half a percentage point federal funds rate cut, to me, really, they reaffirmed that they're committed to getting this to the finish line. And the finish line is not just about getting inflation back down to 2%. That is important. That is their target, and they will get us there. But also taking very seriously what's happening in the labor market. So this economy has surprised me left and right, as it has many other people. So I'm not going to hazard a guess about exactly, what the data look like over the next 6 months, 12 months. And yet to see the Fed starting to move and being willing also to go outside of the box with the Fed. There was a big discussion about, well, the Fed historically doesn't go 50 basis points unless we're in a crisis. And I didn't think we were in a crisis. They didn't think we were in a crisis. And yet they went bigger because they were looking at all the pieces of information, including the fact that the federal funds rate, even now, is still quite elevated. So I expect them to continue to cut the federal funds rate, take out the restrictiveness. I expect them to be hyper data driven, as they have been through this episode, because I mean that in some ways, when your models and your rules of thumb aren't really up to the complexity, the unusual nature of the episode, you're left with reading the data and kind of reacting to it. So I think we'll get there. And though I expect to continue to see easing, I don't expect to see another big cut, say in November, given these data. But as Fed Chair Powell said, the direction is clear where they're headed with their rates.
What's the stopping point, do you think? Where do you think that they might just pause for a long time?
In a way, the best case scenario is they stop as high as possible. And that's not because I, think there's a certain number for the interest rate. And I know, some people want to hear, rates are coming down because buy home or do these things. But that where the Fed stops very much depends on the economy itself. And we should want these kind of job gains, these low unemployment rates, the high productivity, the GDP expansion. That kind of economy that's firing on all cylinders, the interest rate will be higher. That's a healthy economy. The low interest rate economy that we had before the pandemic, that was not entirely healthy, right? So staying away from ultra low interest rates actually is good, not because there's something intrinsic about what the interest rate should be, but it's telling us how strong and resilient the economy is. So I would expect interest rates to be higher, and yet we still have some cuts ahead of us.
I don't want to put too much of a fine point on it, but he's somewhere in the 3 to 4% range, maybe somewhere in there.
Probably something in the low 3% range seems quite possible.
One comment that struck me was that maybe the economy is growing too strong and that there'll be a price to pay at the end, that it'll be a bigger disruption when companies decide to stop hiring. Is that one of the scenarios you worry about?
We should always be vigilant for signs of a bubble or some kind of overconfidence. Those are or overheating, where it looks like we're really running, off ahead of our skis. What we have seen as this recovery has gone on, this move into the expansion, we've seen expansions in the labor force. So we are, prime working age adults are out there. I mean, and we have in some groups that have been on the sidelines, we have more participation than we've had in the past, right? So we've got more workers that have come on after going through a period of shortages and some real not having enough workers in the labor market. But we're in a good place there. Household balance sheets look better than they have looked in a very long time. So there are no signs that this is a credit driven consumer spending or investment. When you look at credit relative to income or assets, right, like things look good there. So that's in a good place. And we've seen, at least up to this point in the last 2-3 years, some really good productivity numbers. So things are looking good also on the supply side of the economy. Now that productivity is one example that can come and go, and keeping that labor force growing as we're facing an aging workforce, like that's these are not givens going forward. But what we're seeing right now in terms of strength, like we're standing on a good foundation. One should always be vigilant for the overheating. One should be vigilant, but you shouldn't be afraid of a strong economy.
One of the questions that economists seem to just not have an answer to is that you say the economy is strong, but many Americans, in the polls and everything, just really express this complete dissatisfaction with things. What's your take on that? Like, why is there such a disconnect? Is it like elites try and talk down to people, or is there a better answer?
There's plenty of people talking past each other, right? I think that's one case, and it may also be the different emphasis. A part of this that got a lot of attention recently was around inflation. And we've seen a lot of progress. Inflation's come down. Economists like me will say, inflation is coming down. This is not a problem anymore. I mean, it had been, we made a lot of progress. And you'll talk to individuals who will often say, well, but the prices are so much higher. Inflation is a big problem. You can still see in polls where individuals, not a trivial amount, will say inflation's even getting worse now. And you're just like, wow. Now, some of this is, economists as a rule, as typically will look at year over year inflation. So we're just trying to get a gauge. And some of it comes back to, what the Fed's mandate is and kind of thinking about the price changes and less looking back over time in levels. And I think to some people, it may be more natural to say, well, as long as my paycheck's keeping up with, the price tag at the grocery, I'm okay. But if you just want to focus on the price tag at the grocery, then I can understand. Like, you have different views. So there is an aspect of we're looking at different pieces of the puzzle, putting a different emphasis on them. And yet there's also the economy. I mean, it's a social construct to some extent too, right? Like in the way people define it and what it means to them. And it gets, information can be very hard to absorb on what's happening in the economy. And then we also have that there, hundreds of millions of Americans and doing in tens of millions of businesses. So these aggregate numbers that are so important for us to keep a pulse on the overall, they reflect no one individual. And so you do have a lot of tension where I think people can very rightly say, well, I had to pay more for, the college tuition, or or my grocery store this happened, or my pay. So there's this kind of disconnect between the aggregates and what's happening to a person. And the last thing I'd say is it is an election year, and the economy matters. Like, there are a lot of people that have an agenda, for better or worse, and it gets funneled through the economy. And there's the way information is shared and news and social media and negativity bias. I mean, it's all out there. But I understand it is, people's livelihoods is extremely central to their day to day. The stakes are high.
It seems that more and more that the election is going to turn on, Pennsylvania, Ohio, Michigan, kind of like that Midwest voter. From our past conversations, I know you grew up on a farm in Indiana, went to college in Ohio. Is there something about those economies? Do they need like this radical overhaul and maybe sort of tariffs to bring back manufacturing? What's the sense there of those economies from your experience?
Right. Well, you certainly can see in the Midwest, there are communities that were hit very hard with the manufacturing not being as focused in the United States. And when you have kind of company towns built up over the auto industry, like, you can go from a really lots of jobs, lots of stuff, to the work isn't there. And then that has all kinds of ripple effects. The housing market is bad and the people don't have the wealth and the opportunities. And there have definitely been cases where there are communities, not just individuals, but entire communities that get hit hard when the economy shifts in a way against them. And it has been a real challenge, and frankly, something that economists and policymakers just haven't risen to the challenge always of that dislocation that's caused. There are winners and losers from, say, trade policy or any kind of economic policy, and they're often not the same people. And it can really add up. So I think there certainly can be a frustration in communities. You also get some of the policies being made in DC can be really out of touch with the reality. And that might be part stemming from if you have communities that are really hard hit and just don't feel like their pain is being recognized. There certainly is a frustration.
Well, thank you so much for your time today. I really appreciate it. We'll talk again soon for sure.
Great. Thank you.